Hello, good afternoon, everyone. It's wonderful to see so many of you here today as we dive into a topic that hopefully can resonate with every single investor. Whether you're just starting out on your investment journey or you are already well along the path, we are here today to discuss the investment strategies for long-term portfolio success. Now, the path to success, it can look different for everyone, and today we have brought together quite a diverse panel with different perspectives to share. So without further ado, let's get started with our first question. And the first one actually goes to Kenny. Kenny, you have quite an extensive experience. You've also navigated through different life stages, so we want to hear your perspective. Kenny, what does long-term portfolio success actually mean to you? And is there one guiding principle that guides your investment decisions?
Thank you, 𝗪𝘆𝘀. Actually, when I was first approached to be a panelist, then I actually found out that they actually have this 20, 30, 40, 50 years. So I definitely belong to the 50 years and above category. Based on the question, like what is long-term portfolio success? I think long-term portfolio success means different things to different people. To some people, long-term portfolio success means having a lot of money in the portfolio, and some of them would think it as like can enable them to achieve financial independence. But I think to me, what I would view long-term portfolio success is to have a portfolio that you actually crafted that will be able to generate a realistic and a reasonable return over a long period of time. And when I talk about long period of time, I'm talking about horizon about 10 to 20 years. So, for example, personally, I would be happy if my long-term portfolio performance will be able to generate anywhere in nominal terms 7 to 10%. So, assuming an inflation of 3%, then you still get about 4 to around 4 to 7% kind of net return. I think that's decent, especially if you can compound it over a long period of time. In terms of some of the guiding principle of actually coming out with this long-term portfolio, I think it's important to have a couple of guiding principles. And to me, the first is you have to know your own investment objective, and you have to know your own risk appetite. And secondly, I think it's also important to have a realistic, sometimes can be a bit aggressive, but a realistic kind of investment return target. Because let's say you're looking at a 15, 20% compounded over 10, 20 years, I think that is not even Warren Buffett is able to achieve that kind of return. But I think having something that's realistic will guide you in terms of having the proper asset location. And thirdly, I think it is also important because I know a lot of you may not have a lot of time potentially to manage and look at your portfolio actively. So sometimes I think products like ETFs, products like UTs, I think give you a very good broad exposure to the asset class that you would like to have. And last but not least, I think it's also important to understand investing is for the longer term. I think a lot of speakers today already kind of like harped onto this point. And having been an investor for more than 30 years, I think what taught me is that, having a consistent return, understanding the rule of compounding actually will get you to your portfolio, long-term portfolio success, over the years.
Thank you, Kenny, for sharing. So as we reflect on what success means, I think it's also equally important to really learn from the lessons that we have gained along the way. So that also brings me to my second question, which is for both 𝗪𝘰 as well as Kenny. Looking back, is there an investment decision that you regret, and how did that teach you about long-term portfolio success?
Okay, hello everyone, good afternoon. My name is 𝗪𝘰. Kenny, don't mind I go first. I'm sure you have more regrets than me, right? 30 years. Okay, So I can see most of you here are very experienced in investing. I will share with you my regret, and I think some of you may have gone through the period of time. How many of you started investing since 2007? Can I get a show of hands? Oh, just a couple? Okay. So if you still remember what happened during 2007 to 2009 period, I started out working as an analyst back in 2007. So fresh analyst working at FSMOne, the time was known as One Supermart. So doing a lot of research, knowing the macros well enough as well as the various different products. Of course, I got a bit confident and ambitious. 2007, at the end of the year, I was all in equities funds as well as Singapore stocks. After that, that's where the great financial crisis happened. Everything started to tank. There was a short rebound in 2008. I didn't do anything much, but finally it continued to go down all the way to March 2009. Around that time, I gave up. I sold everything, and I moved predominantly into fixed income. I got scared by the whole investment experience, and I stayed uninvested for the next couple of years, 2 years. And for some of you who have raised hand earlier on, you know that March 2009 was the bottom of the great financial crisis. After that, we have a spectacular rebound just within 6 months, from April all the way to October of 2009. So this was one of my greatest regrets. I swung from fully invested all the way to become like totally not invested in the market. I missed out the rally entirely. And the lesson that I could learn from this after so many years is really how to avoid falling prey to greed and fear. There are a lot of emotions out there when it comes to investing. If you can control greed and fear, you will tend to do very well. Of course, it's quite subjective. How do I overcome it in a more quantitative manner would be really looking at how you do asset allocation. So for example, right, if you just set properly your asset allocation, a balanced investor, you should have, say, for example, 50% into equities, 50% into safer bonds, right? Regardless of where the markets are going up or going down. If the markets go up a lot, and you set a threshold of, say, plus minus 5%. So if equities market go up so much, there will be a point that you reach 55% in equities and 45% in bonds. You know that markets have gone up quite a bit. This is not the time to take more risk. Don't add in more money into the equities market. Take a look. Sell off that 5%, rebalance the entire portfolio to 50-50 again. On the converse, when markets tank a lot, you won't be afraid. But if you have predetermined that your asset allocation is 50-50, there will be a time where you see your portfolio ended up with just 45% equities because they have dropped so much. And you have 55% into bonds. What you have to do is just sell off the bonds, buy into the equities, bring it back to 50-50. So over the long term, markets can be very volatile, but every time markets go up, it's a very systematic way of selling off your equities. And when markets are going down, it's a very systematic way of selling off bonds and buying into the equities, which is a lot cheaper right now. So you can follow this. I find that it is easier to control your greed and fear. You do not have to sell every time there is a bad news coming in. So that's my lesson to share. Kenny?
Yeah, since 𝗲𝘃 shared 2007, so I think I'll share a bit earlier that the Asian financial crisis. I think some of you may not have experienced that. That was in 1997, 1998. In fact, for those people who have experienced that period, it actually was the worst. You have like Thailand going bankrupt, Korea almost bankrupt, and they need to seek help from the IMF. I started off in the industry in 1991, so then, I started off as an analyst and, covering stock. So at that point in time, because, being young, being ambitious, being aggressive, so when I cover some of the markets, and at that point in time, the popular markets actually are the Southeast Asia markets, Indonesia, Thailand, Philippines, not China, not Korea, not Taiwan, not even US. That time, I don't think we have a platform like FSMOne that you can easily, just buy US stock. And also some of our competitors also offer such kind of platform. But at that point in time, I think what happened was that, I think I know how to analyze stock. As an equity analyst, I know how to buy stock. But actually, I prefer to look at those small cap stocks that potentially can give me 2-3 times return. So what I did was I poured quite a bit of my savings into buying specific small cap names. And, initially, of course, the experience was good, make good return, very short term focus. And then came the Asia financial crisis. There was a devaluation in a lot of the Asian currencies. I mean, for those who knows Indonesian rupiah devalued from 2,300 rupiah to 10,000 rupiah, and it never turned back after that. So it's still above 10,000 rupiah at this point in time. So all my small cap investment, which has been making me good money, suddenly went bust. So I lost a lot of money in small cap. My entire exposure was in small cap. That was very painful because, a few years of saving, especially saving for my marriage, all the money has gone down to the drains. So what I think is the lesson learned at that point in time, I think fortunately I was still very, very young then. I was in my 20s, late 20s. So I think I still have a lot of time to recover a lot of the potential losses. So I think that also taught me about diversification. That also taught me about not putting all your eggs into one basket, regardless of how smart you think yourself are or how good you think yourself are. I think sometimes black swan events are unpredictable. And it's really wasteful that you lost all your capital within a very short period of time. So the concept of diversification, the lesson of having proper asset allocation, I think we have shared about allocation between some safe asset class like fixed income versus equities. I started to appreciate asset allocation as being a more important part of the wealth creation process over time. And I think good to say that in 2007, 2008, I did not experience the kind of losses that I experienced back in 1997, which basically wiped out everything I have. But then I think having that kind of mindset, having that kind of proper asset allocation, I think is extremely important for investors who are thinking about long-term wealth creation.
Thank you, Kenny. So apart from Kenny and 𝗲𝘃, you are also looking at Jerry and I, who represent the younger generation, so people in our 20s. So nowadays, you may have also heard that many individuals from the younger generation, they tend to start their investments at an early age. So I want to bring in a fresh perspective coming from Jerry. Jerry, can you share what inspired you to start investing?
Hello. Hi, everyone. So what started me investing is realizing that having one source of income is not enough to survive with the rising cost of living. So this was during my NS days where I was talking to my bunkmates about career aspirations, about the rising living expenses and how crappy our allowance was. So I started to look at different options, and I discovered that investing is the most effective way to grow your money due to its relatively low barrier to entry, like low startup costs, low fees, etc.
And I also want to share my experience for as well. So similar to Jerry, I started investing because I wanted to grow my wealth. So I came from a finance background back in university. I think one of the most important lessons I learned during my time there was about the time value of money and the power of compounding, which I think Kenny also mentioned just now. So essentially, the earlier someone starts investing, the greater their potential to grow their wealth over time. So that made me realize that I needed to put my money elsewhere rather than just having it inside a bank or a fixed deposit account. And for me, I think my first step into investing was through SGX stocks. I think many people will start out from your home market, but I also soon realized that there's also risk of having a home bias, and it's also important to have a globally diversified portfolio. So from then on, I began to venture into other major markets like the US and China, for instance, to capture more opportunities on the global scale. And I think among the younger generation now, there's also been an increasing trend of investing in the more speculative assets, such as cryptocurrencies and meme stocks. And Jerry, you probably have some friends who have invested in crypto. So can you share, do FOMO or your peer pressure influences your investment decisions? And how do you manage or respond to such feelings of FOMO?
So for myself, I would definitely say I get FOMO, especially when I hear people like doubling or tripling their investment in those asset classes. So I mean, it's only natural like to wanting to have that piece of lucrative growth, right? So how I manage that feelings is like having an own personal investment framework, which is before I invest in any trend, I'll ask myself, does this align with my risk tolerance, and have I done enough fundamental research? For example, looking at its relative returns compared to its absolute, looking at its long-term viability and the current market conditions. I feel that this approach, along with setting clear investment goals, helps me to make evidence-based decision rather than emotionally ones. So, 𝗪𝘆, how about you? Do you get FOMO?
For me, I actually don't get FOMO, but I feel it's very easy to feel the pull of peer pressure, especially when you hear about how some of your friends are making a lot of money off crypto. But I think that when you follow such volatile trends, which I think are not backed by fundamentals, you are more of gambling rather than investing. I mean, sure, the returns from crypto, they can look very exciting, but they also come with major risks. For me, I'm more of a fundamental investor, so I look at fundamentals such as the financial health or the cash flows of the companies when I'm investing. So I think it's really worth taking a step back and asking yourself whether an investment is aligned with your financial goals and risk tolerance, and also whether this investment is based on solid fundamentals, or are you just simply chasing the hype. So, okay, we have spent some time discussing speculative assets, so I want to shift the focus now to something that requires more stability and reliability, that is CPF investing. So for those of you here who are planning for retirement, you might want to consider investing your CPF funds. And that also brings me to my next question, which is for Kenny as well as 𝗪𝘃. Have you ever considered investing your CPF savings instead of leaving them inside the account to earn the risk-free rate? What kind of key factors that guide your decision in doing so, and how do you balance between the risk and the reward?
I think for CPF, I mean, just for your information, I think a big part of my CPF has to be transferred to the retirement account. So, because I'm past 55. But I think in the past, when you look at the kind of interest rate that CPF is offering you, 2.5% for ordinary account, and I think currently is it 4.5% for special account and also retirement account. I think it definitely looks very attractive, especially in the past compared to what the kind of almost zero interest rate that you get from the bank when you put the money there. But I think in the past 2 to 3 years, things have actually changed quite a bit. Because of inflation, because of the sharp rise in interest rate. Currently, I think to get 2.5% is not that difficult. In fact, you can actually, again, this is a marketing pitch, but you can actually invest in Sing dollar auto sweep and you get 2.7% or more. And other money market fund also offer you a better interest rate. I'm not suggesting that this rate will stay there forever, but I think investors have a lot more opportunities. But one thing I just like to highlight is that CPF money is your retirement savings. So it is not for you to spend recklessly into investing into very highly speculative, very high, so that you hope to make a lot of money, but then in the end you lose everything. So I think that should not be the mentality when you approach your CPF saving. As at least this is not the kind of approach that I would approach it when I think about my CPF money. But I think interestingly, if you look at the CPIF investment scheme, there are a lot of products. Some are relatively safe one that you can actually invest your CPF money in. So I think that actually would enable you to find potentially better yielding asset, especially for your ordinary account?
Okay, so 𝗫𝗲 has shared with you, most of his money is in already RA. But for myself, of course, I still have OA as well as SA, a couple of more years before I have to make the switch. So for me, I mean, if you split CPF investable assets that you can do with your OA as well as SA, you know that respectively the opportunity cost is 2.5% and 4%. So for short, I don't invest my SA money. I think 4% is a very decent yield. I'm happy to have it there. And eventually that money will be converted into RA. Okay? So I don't touch my SA money. Right? There may be opportunities to earn higher returns, but at 4%, almost risk-free, I don't touch it. But for the OA monies, the returns, the opportunity cost is just 2.5%. If you put a portion of it, you don't have to take out everything. You put a portion into it, into just a simple global equity kind of funds. Over the past 20 years, right, the annualized returns, we are looking at 9 to 10%. So 2.5% versus a potential of 10% return, annualized returns per year, I think that risk to reward is worthwhile. I'm willing to give out that 2.5% safe return and take some risk with global equity funds.
But 𝗲𝘲, with so many CPF-approved funds on our platform, it can be a little bit overwhelming for investors. Is there any products that you think stand out to you?
Okay, I think when I was a research analyst looking at all these products down there, it can be overwhelming. Too many products out there. But as you work a bit longer and you start to focus a bit more on your career, the way I look at investment is to streamline it and how to make it simple and simple. So I don't look at all the products, I just pick one, Infinity, you can mention the name. Okay, the product by Lion Global, Infinity Global Equity Fund. So it's passive index funds. It gives you exposure to more than 1,400 companies. So you just leave it there. I'm expecting a return of at least 7 to 8% annualized. So that's just one product I look at. I don't look to form fancy portfolio or spend too much time curating various different asset or sector exposure with the CPF monies. So that's how I've been doing it, just one product. But if you, of course, if you have a very short time horizon, please don't go into this kind of all equity kind of product. Like what 𝗫𝗲 has mentioned earlier on, if you have shorter investment horizon and you still want to make returns slightly higher than 2.5%, you can take a look at the short-term duration bond funds. And some of these short-term duration bond funds, risk is definitely higher than leaving your money in OA. But the upside is that the yield to maturity, the current yield is around 4 to 4.5%. So that's my advice to people who intend to use CPF monies.
For me, I really like low-cost investment options. I think passive funds, they are an excellent choice because they are cost-efficient and they tend to track major equity markets, which provide us with diversification. So it's like actually similar to 𝗲𝘲, I like the Infinity US Stock 500 fund. This is not a plug for Lion Global, but I think this fund is really decent if you are trying to invest your CPF savings, low expense ratio, and it tracks the performance of the S&P 500. So I hope that these insights from myself, 𝗲𝘲, as well as 𝗫𝗲 can help you to better plan for your retirement. Looking ahead, we can likely all agree that markets, they will remain volatile. Trump's returning as the US president, and there's also an uncertain path towards disinflation. I think all of this can add to policy uncertainties this year. So I want to hear from 𝗫𝗲 as well as Jerry. With markets changing so rapidly, is there an investment strategy that you think will be able to stand the test of time?
Shall I start? I guess, I think that's a very good question. So for myself, up to this point, my investment strategy is primarily focused on stocks. And I do think that there are some generalized principles that can be transferable to other asset classes. So for myself, I believe that investing in what you know will stand against the test of time. So it was by Peter Lynch, a book that I read. And the key takeaway from this book is just saying that investing in companies with a compelling story, meaning strong fundamentals and products or services that are relatively easy to understand. So it was his principles that I bought like Apple at the start of my investment journey due to its straightforward business model, strong cash flow, at the same time, favorable market condition. So I think on a maybe fund or product perspective, the book also mentioned about investors should only sell when when a story changes or when a story is wrong. So I do believe that his principles is what will stand against the test of time.
Yeah, for me, I think I'm still a very old-fashioned investor. So I mean, crypto is a no-no for me. Not because I don't think people cannot make money from it, but I really don't understand, what drives the share price. It's kind of like herd investing. Investors just buy when things are going up and sell when things are going down. So it's hard for me to appreciate that kind of asset class. But there are certain time-tested asset class like, the traditional equities, the traditional fixed income. And a lot of people will try to time as to when would be the best time to go in and out of it. And to me, like, rather than trying to time it, I think if you have a proper asset allocation, like for example, whether it's 50-50 or 60-40 or 70-30, again, that depending on your investment horizon and also your risk appetite. I think that actually will give you, I would say, a less risky path to actually achieve your financial objective. Because I think for equities, what I tend to look for are actually investment that are in a way test and proven. So interestingly, 𝗪𝘃 and 𝗪𝘆 mentioned about the S&P 500, the Infinity by Lion Global. But I think why a lot of people are now beginning to be very excited about US companies. It's not just because US is a big country or is a big superpower, but you can see a lot of quality companies with market leadership, companies with global reach, and those are the companies that you want to get yourself exposed to, especially on the equity space. But again, your investment horizon it should be a longer term one. Fixed income, I think, is more for capital preservation to give you a steady income stream. So if you combine both asset allocation, so achieving the 7-10% kind of return consistently over a long period of time, I think is not a very difficult proposition for a lot of people. I think the importance is having the patience. The importance is having also the persistency, and also the ability not to be swayed by a lot of those market movements.
And to wrap things up, my final question goes to 𝗪𝘃. I believe the audience will want to hear what are some of the exciting opportunities that lie ahead. So 𝗪𝘃, is there any markets, sectors, or themes that you believe will be able to deliver substantial growth potential in the next couple of years?
Okay, not too sure whether just now the way I explained some of the questions that you have asked, you know that I'm just focused more on asset allocation. So I don't really pick sectors or very interesting ideas on its own to invest in. If you take a look at my entire portfolio, the only thing I try to make sure it adheres to is a 70% equities, 30% bonds kind of allocation. And if you take a look, where most of them are in the global stock index related kind of funds or ETF. So it's not even S&P 500. I was just a global, so it's a lot more diversified. The only few tactical allocations that I have would be world financials as well as Japan. And all these ideas came from the research team. So maybe 𝗪𝘆, you can elaborate a bit more what other exciting ideas we have in the coming year.
Yeah, for me, the most exciting idea that I have will be the Japan stock market. I think Japan has really made a comeback after decades of sluggish performance. You can see the comeback in the last 2 years. The stock market has really rebounded. For the interest of time, to make things short, why I like Japan is because I think this comeback in the equity market that is being backed by tangible changes within the economy. We are seeing wage growth after decades of no growth. And there's also the shift from deflation towards inflation. And last but not least, there's also corporate reforms going on in Japan that is aiming to boost shareholder returns. Japan itself is also trying to revive its semiconductor industry, supported by its expertise in terms of advanced manufacturing, as well as the hefty subsidies given out by the Japanese government. And with these advancements in AI, and also with global chip makers who are now shifting their supply chains because of geopolitics, I think that Japan could be well positioned to benefit in the coming years. So we've actually covered quite a lot of ground in today's panel discussion, from the meaning of long-term portfolio success to lessons learned from the past, and also the exciting opportunities that lie ahead. I hope that today's conversation has inspired you to really reflect on your own investment strategies, and also to explore more opportunities to build a portfolio that is aligned with your long-term vision, which will help you to achieve your own long-term portfolio success. So on behalf of our panelists here today, thank you so much for joining us. We wish you all the best in your investment journey, and also good luck for the upcoming Grand Lucky Draw. Thank you.